Your card declines not because you're broke, but because an algorithm decided you spent enough this month. Your savings sit visible on the screen, untouchable, every door locked. This is the system being built right now. In our last 3 investigations, we showed you how private banks create money from nothing through debt, how the coming CBDC grid could embed expiration dates, spending limits, and kill switches into your currency, and how the Federal Reserve operates as a private cartel paying dividends to shareholders whose names you'll never know. But they overlooked one critical vulnerability. The system only works if you stay inside it. Today, we're revealing the Anti-CBDC Portfolio. 5 assets they cannot program, freeze, or delete. 5 exits from the 97% pattern. If this is your first time here, subscribe to the 97th percent. This is your escape strategy. Your bank account shows a number. You assume that number is your money. It isn't. The moment you deposit cash, something quietly shifts in the legal structure. That money becomes the bank's property. What you receive in exchange is an IOU, a promise they'll return it when you ask. Read the account agreement buried in that stack of papers you signed. In legal terms, you became an unsecured creditor, holding a claim against a private corporation's balance sheet. Your wealth now depends entirely on someone else's solvency and willingness to pay. Financial experts call this counterparty risk. In March 2013, the people of Cyprus discovered exactly what that risk looks like. They woke up one Saturday to find every bank on the island had closed not temporarily, but indefinitely. ATMs stopped dispensing cash, and when the doors finally reopened 2 weeks later, depositors with more than 100,000 euros discovered that 47.5% of everything above that threshold had simply vanished. Not seized by courts, not taxed by parliament, confiscated to save the banks themselves. This mechanism has a name: the bail-in. Unlike a bailout where governments rescue failing banks with taxpayer money, a bail-in forces depositors to become involuntary investors in the very institution that lost their funds. Your savings become their insurance policy, converted to shares in the bank without your consent. And Cyprus wasn't a one-time experiment. The European Union codified bail-in procedures into law with the 2014 Bank Recovery and Resolution Directive. Canada has updated its banking laws to include similar provisions. The template now exists in financial systems worldwide. If your money sits on their ledger, you're not a customer. You're a creditor waiting in line behind bondholders and executives. 97% of all currency is bank-created debt. Your freedom lies in the remaining 3%. Assets you own outright with no middleman between you and your wealth. What do drug dealers, billionaires, and central bankers have in common? They all understand something about cash that you were never taught. You've heard the talking points. Physical money is outdated, inconvenient, something only criminals prefer. Meanwhile, the institutions designing the surveillance grid are quietly stockpiling the exact assets they're telling you to abandon. Start with the simplest exit from the digital ledger: physical cash. Unlike a central bank digital currency, cash carries no expiration date embedded in the paper. There's no approved merchant list to consult before spending, no software decides whether your purchase aligns with policy goals, and when you hand someone a $20 bill, no server logs the transaction. Your identity isn't tracked, and no bureaucrats can reverse it with a keystroke. This is precisely why they want to eliminate it. Now consider physical gold and silver. These metals have survived every monetary scam in recorded history. The Roman Empire debased its denarius until the coins contained almost no silver. Gold held its value. Weimar Germany printed marks until citizens used them as wallpapers. Gold remained stable. Nixon severed the dollar from precious metals in 1971. Gold's purchasing power endured. 5,000 years of currency collapses and empire failures, yet gold and silver still outlasted them all. What the financial news won't mention is that central banks are buying gold at the highest rates since records began. In 2022, 2023, 2024, and 2025, central banks globally purchased over 1,000 tons each year, more than double the previous decade's average. China, Russia, Poland, and India all aggressively stockpiling physical metal while their governments push digital payment systems on their citizens. The architects of tomorrow's monetary system are buying gold for themselves. They know the paper is fake. They're trading it for what's real before the door locks. The critical principle here is physical possession. Paper, gold, ETFs, and bank-held cash reintroduce the exact counterparty risk you're trying to escape. If you don't hold it, you don't own it. In January 2022, thousands of Canadian truckers drove their rigs to Ottawa. They called it the Freedom Convoy, a protest against vaccine mandates that had cost many of them their livelihoods. For 3 weeks, big rigs blockaded the capital. Donations poured in from supporters worldwide. The government's response became a case study in financial warfare. Prime Minister Trudeau invoked the Emergencies Act, the first time in Canadian history. Banks froze accounts without court's orders. Insurance policies were cancelled, but authorities didn't stop at traditional finance. They went after cryptocurrency too. Within days, police ordered every regulated financial firm in Canada to block transactions from 34 crypto wallets holding nearly $1 million in donation. No individual court orders, no lengthy legal process, just bulk freezes executed in hours. The truckers had moved their money out of the banking system, and it didn't matter. Their fatal mistake? The funds sat on centralized exchanges like Coinbase and Kraken. Those exchanges answered to regulators. When the government called, compliance departments complied instantly. Even Kraken's own CEO, Jesse Powell, warned users publicly. If you're worried about seizure, don't keep funds with any centralized custodian. We cannot protect you. The truckers held IOUs, not assets. The private keys belonged to the exchanges. They'd escaped one prison for another with a different jailer. Exchange-held cryptocurrency is just another database controlled by a company with lawyers, a compliance department, and executives who can be subpoenaed. If your holdings sit on an exchange, you're still inside the system. Self-custody changes the equation entirely. When you hold your own private keys, you hold the actual code. No intermediary, no counterparty, no one who can lock you out. Hardware wallets like Ledger and Trezor store your keys offline, completely disconnected from the internet. Your assets exist on the blockchain itself, not on any company's server. There's no customer service to call, no compliance department reviewing your transactions, so make sure you keep your crypto in a private wallet. The network operates across thousands of nodes scattered around the globe. No headquarters to raid, no CEO to arrest, no central server to shut down. Self-custody is the digital equivalent of a gold bar, locked in your own safe. Nobody can take what they cannot touch. But stored wealth is purely defensive. What happens when you need to generate income they can't intercept at the source? A stimulus check can be programmed to expire in 30 days. A harvest cannot. China is already testing this. Their digital yuan pilots included a feature most Western media ignored: programmable expiration. Authorities can distribute stimulus payments with built-in countdown times, spend the money at designated merchants within the permitted window, or watch it vanish from your wallet. Not confiscated, not taxed, programmed to self-destruct. This is the future of controlled currency. Your money becomes a depreciating coupon with an expiration date set by someone else. And if money expires, it becomes impossible to save. But certain assets exist outside this logic entirely. Consider land that grows food. Every season, regardless of what rules get embedded in the dollar, crops emerge from the soil. A rental property generates income whether the currency is programmable or not. Solar panels produce electricity. Livestock reproduce. Equipment builds things people need. These assets pay dividends in real-world value, not permission-based digits that require approval to access. A programmable stimulus expires on schedule, surveilled at every transaction, conditional on compliance. A productive asset yields perpetually, operates autonomously, and answers to no central authority. This is how generational wealth has always been preserved. The Rockefellers, the Rothschilds, European aristocratic families that survived every monetary transition for centuries, they don't hold digits on someone else's server, they hold dirt. They hold assets that produce regardless of which currency exists or which government holds power. Yes, titles and deeds face legal challenges. Governments complicate ownership through regulations and taxation, but the physical asset remains. The crops still grow. The rent still arrives. The solar panels still generate. You can't program a harvest to disappear. Cash, metals, and self-custody crypto store your wealth where they can't touch it. Productive assets generate wealth they can't intercept, but there's still one gap in the fortress. If every merchant you need requires their payment network, you're trapped inside the grid regardless of what you own, unless you build something else entirely. There's one asset no government, no algorithm, no central bank on earth can seize. They can freeze your bank account, flag your crypto wallet, decline your transaction at the point of sale, but they cannot reach inside your head and delete what you know how to do. A plumber who can fix a burst pipe holds value no digital system can erase. A mechanic who rebuilds engines creates worth that exists entirely outside the financial grid. An electrician, a carpenter, a nurse, a farmer who understands soil and seasons, these people carry wealth in their hands that no authority can confiscate. Think about what a social credit score actually requires to function. It needs a closed loop, every transaction flowing through monitored channels, every exchange tracked and scored, every interaction requiring permission from the network. The whole apparatus collapses the moment you have somewhere else to go. But when you possess a skill your neighbor needs, you become that somewhere else. They can cut off your card. They can't cut off your ability to rewire someone else's kitchen. Argentina proved this in 2001. When the peso collapsed overnight and banks locked their doors, millions of people didn't starve. They adapted. Barter clubs called trueques spread across the country. Estimates suggest between 2 and 7 million Argentinians participated. Dentists traded checkups for haircuts. Teachers exchanged tutoring for plumbing repairs. Mechanics fixed cars for groceries. Entire communities built parallel economics that functioned completely outside the banking system. The same pattern emerged in Venezuela, in Zimbabwe, in every country where trust in central currency evaporated. This probably sounds like some primitive pre-modern bartering system of existence, but these were important and resilient networks that formed because people had real skills to trade. The Federal Reserve owns the rails, but they don't have to own the passenger. 5 assets, 5 exits from the digital cage, cash they can't track, metal they can't delete, keys they can't seize, land they can't program, and skills they can't touch. The only question left is which one you build first. You now have the receipts of the scam, the blueprints of the prison, the names of the shareholders behind the curtain, and now the shield. But understand the timeline you're operating on. While you watch, this legislation is being drafted in closed rooms. Digital infrastructure is being tested in pilot programs across dozens of countries. Every month of delay is a month closer to the cage snapping shut. You don't need all 5 assets tomorrow. You need one today. One single pillar that proves to yourself the cage has gaps, that exits exist. Physical cash on hand right now. 1 ounce of silver in a drawer. A hardware wallet with keys only you control. A skill someone would actually pay for. Pick one. Start there. Once you have one of these asset classes, you can add more over time. Just don't take too long. Share your plan in the comments below. What's the one asset you're building first? If this investigation opened your eyes, hit like and subscribe. This fight is far from over. Our next video is an important one. We reveal the event being engineered right now to force everyone into the digital cage at once. You don't want to miss it.